The Federal Reserve has made a critical decision to hold interest rates steady, signaling ongoing inflation concerns. This could have monumental repercussions for investors and the economy. Here's what you need to know about today's pivotal news. In recent weeks, the financial landscape has been marked by heightened uncertainty as investors brace for forthcoming inflation and employment reports. These critical indicators will offer insight into the Federal Reserve's potential actions in the near future. The economy has shown signs of slowing growth, prompting speculation around possible rate cuts as early as September. However, prevailing sentiment among economists suggests that interest rates may remain elevated for an extended period. Analysts are currently weighing two distinct scenarios: one where inflation significantly subsides, creating room for a policy shift towards rate cuts, and another where inflation proves persistently high, necessitating additional hikes to curb rising prices. The implications of these scenarios are profound, influencing everything from consumer spending to business investment. Investors are advised to closely monitor key indicators, including the upcoming Consumer Price Index release and the latest employment figures. These reports will not only shape market expectations, but also impact the Fed's decision-making process. Furthermore, remarks from Federal Reserve officials will be scrutinized for any hints regarding their policy direction. A change in rhetoric could signal a shift in the Fed's approach, prompting immediate reactions in the stock and bond markets. As we navigate this complex economic environment, one pressing question remains: how will investors respond if the Fed maintains its current rate stance longer than anticipated? Such a scenario could lead to increased volatility in financial markets as investors recalibrate their strategies in response to prolonged higher rates. Looking ahead, the upcoming economic data and Fed communications will be pivotal in determining the trajectory of monetary policy and, ultimately, the broader economy. Investors should prepare for a period of adjustment as they assess the evolving landscape of interest rates and inflation. The lead-up to the Fed's decision involved complex economic signals that have left many analysts puzzled. In recent weeks, labor data has shown signs of cooling, with job growth slowing to its lowest level in over a year. Concurrently, inflation readings have exceeded expectations, raising concerns about the Fed's ability to manage price stability effectively. The central bank had previously indicated potential rate cuts, but the latest data has shifted this narrative, suggesting a more cautious approach. The combination of weaker labor statistics and persistent inflation has left investors on edge, creating a climate of uncertainty in financial markets. Historically, the Fed has faced similar challenges, particularly during the tumultuous 1970s when inflation surged to unprecedented levels. Past decisions to raise or lower rates were often influenced by immediate economic indicators, leading to both short-term relief and long-term consequences. However, this time, the stakes feel higher as markets react sensitively to every macroeconomic release, with traders keenly focused on how long elevated borrowing costs will last. The impact of these developments extends beyond Wall Street. Consumers are feeling the pinch as rising prices affect everyday expenses like groceries and gas. Businesses, too, are grappling with the consequences of fluctuating interest rates, which can hinder investment and expansion plans. Small enterprises, in particular, are facing tighter margins as costs rise. As the Fed navigates this intricate landscape, the outlook remains uncertain. Analysts predict that the central bank may adopt a more data-dependent approach, closely monitoring economic indicators before making any drastic moves. With inflation still a pressing concern and labor market dynamics evolving, the Fed's next steps will be critical. Investors anticipate that the coming months will reveal whether the central bank can strike a balance between growth and inflation control. The Federal Reserve's recent decision to keep interest rates steady has significant implications for both the stock market and the broader economy. By maintaining its current restrictive monetary policy, the Fed aims to combat inflation while supporting economic growth. This cautious approach comes in the wake of persistent inflationary pressures that have affected consumer purchasing power and overall economic stability. As a result, interest rate-sensitive stocks, particularly in sectors like real estate and utilities, will continue to face downward pressure. Companies that heavily rely on borrowing will see their financing costs remain elevated, which could hinder their expansion plans and profitability. This situation is particularly crucial for growth-oriented stocks in the technology sector, which now face a higher bar for achieving profitability amid increased competition for capital. The ramifications of this decision are extensive and far-reaching. Analysts suggest that over 70% of publicly traded companies could experience valuation adjustments in response to the Fed's stance. This adjustment reflects a recalibration of investor expectations in an environment characterized by persistent inflation. For average investors, these market dynamics signal a shift that necessitates careful portfolio reassessment to mitigate potential losses. Moreover, the dollar is expected to maintain its strength, and short-term yields are likely to remain supported, further complicating investment strategies. The implications of the Fed's decision extend beyond stock market fluctuations. Consumer borrowing costs are likely to remain elevated, which could dampen spending on big-ticket items such as homes and automobiles. High mortgage rates may stall the housing market's recovery, affecting overall economic growth and stability. As consumers grapple with increased costs and tighter credit conditions, businesses may also face reduced consumer demand, impacting their revenue forecasts. Looking ahead, the Fed's policy decisions will continue to play a crucial role in shaping market conditions and economic performance. Investors should remain vigilant and adaptable, as the landscape is likely to evolve with ongoing economic indicators. The Fed's next steps will be closely scrutinized, particularly as inflation trends and employment figures emerge. As companies and consumers adjust to these new realities, the potential for volatility remains high, underscoring the need for stakeholders to prepare for a period of uncertainty and strategic recalibration in the coming months. On July 28, 2026, the Federal Reserve announced its decision to maintain the current interest rates, leaving them unchanged. This announcement was made during the Federal Open Market Committee meeting held in Washington, D.C. at 2 p.m. EDT. Fed Chair Jerome Powell confirmed that inflation remains persistent despite ongoing efforts to bring it under control. The decision to keep rates stable was anticipated by many analysts. However, it carries significant implications for investors and consumers alike. The most striking detail from the meeting was the Fed's acknowledgement of sticky inflation, a term that indicates underlying price pressures are proving difficult to dissipate. This suggests that rates may remain elevated for an extended period, potentially influencing economic behavior across various sectors. Historically, the Federal Reserve has adjusted interest rates in response to inflationary pressures, balancing the need for economic growth with the necessity of price stability. The current economic landscape, shaped by post-pandemic recovery and persistent supply chain disruptions, has created a complex environment. Consumers are feeling the pinch, as rising prices on essentials like food and energy continue to strain household budgets. The Fed's decision contrasts sharply with market expectations of a more dovish approach, one that would suggest potential rate cuts in the near future. Instead, the central bank's focus is clearly on the challenges of inflation management, indicating a commitment to stabilizing prices even at the risk of slowing economic growth. The implications of this decision are profound. For investors, the continued high interest rates could mean lower borrowing costs for businesses, but higher costs for consumers, which may dampen spending and investment. The housing market, which has already shown signs of cooling, could further stagnate as mortgage rates remain high. Additionally, sectors reliant on consumer spending may face headwinds, affecting overall economic performance and potentially leading to a slowdown in job growth. Looking ahead, analysts are closely monitoring the Fed's next moves. With inflation remaining stubbornly high, the central bank may need to adopt a more aggressive stance if price pressures do not ease. As the economy grapples with these challenges, the Fed's commitment to controlling inflation will shape monetary policy decisions and economic stability in the coming months. As we consider the Fed's decision to hold rates steady, how will investors respond if this environment persists? Share your thoughts in the comments, and subscribe for daily deep dives into market developments.